Are you sure?
Here's the 30-second lesson on what legends know. Never ask a bride why she's getting married. Don't wear a skirt on a windy day. Deodorant is not a shower. Don't sniff chili flakes. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macrosutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and this time we're going to be discussing all of the recent data that's come out from global economies that potentially could impact India. There's inflation data from the US, there's economic data from the UK, there's of course China, and there is what's going on in the Red Sea. All of these have the potential to impact India, but how? For that, we have Radhika Pandey, Associate Professor at NIPFP, to tell us. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
Now, Radhika, I'm going to start unusually with an audience question because it is the first thing that we should talk about. Gautam asks, the US inflation is showing an uptick again, which might delay the change in the Fed rates. Do you feel this could have a substantial impact on FDI flowing into India? And also, are there any specifics in the US data that could impact the Indian inflation levels as well?
So I think more than the FDI, it would impact foreign investment, the portfolio investments,
Right.
Because what happens is that, because as rightly pointed out, the US inflation, even though was lower than December number in January, but it was higher than expected. So it
Right.
was expected that it would be around 2.9%, the US CPI inflation, but it came at 3.1%.
Okay.
So it was higher, and then it dashed hopes of rate cuts anytime soon, because it was earlier expected that in the next meeting, which is due in March, the Fed might start cutting interest rates because inflation has come down.
Right.
But because it was higher than expected, the rate cut hopes have been now, postponed to the second half of the year.
Right.
So, and this had implication for the US bond yields, because when the interest rates rise, the interest rate on the US 10-year bonds, 5-year bond, 2-year bond also tend to rise. Now, if that rises, then there is a greater flow towards these safe haven assets.
Right, money parked elsewhere starts going there.
Yes. So,
Right.
and in that context, Indian markets would be impacted, and of course, we have already seen that happening in January, because in December and in November and December, foreign portfolio investors were net buyers in the Indian market.
Right.
But in January, they turned net sellers, and one of the main reason was that the US bond yields were higher. And after this inflation number that came out on 13th of February, in one day, there was a 30 basis points jump in the
Wow.
US 10-year bond yield.
Okay.
So that would have some impact, potentially destabilizing impact on the markets, because there would be some, again, reallocation of funds from one market to another, from EMs to the US market, because in relative terms, or after adjusting for risk and exchange rate and other risks, dollar tends to become more attractive when the US bond yield tends to rise. So more than the FDI will be impacted by other factors, macro fundamentals. A lot of other factors go into determining the FDI decision, both in the host and in the destination economy. But the more direct impact is going to be seen on the portfolio flows.
Okay. And now, just as a kind of a side question to this, you mentioned that inflation in the US was from 2.9, the expectation, it came in at 3.1.
Yeah.
Now, maybe we should talk about that. If there was such a small differential in a place like India,
Right.
it wouldn't be that big an issue. If you say that we expected it to be 5% and it came to 5.2, that won't cause any waves. But in developed countries, such a small thing does make a difference. Right?
Yeah, that's the big difference between developed economies and here, because there they are looking at the possibility of a rate cut with great interest, because the interest rates have been raised aggressively for quite some time. time. There have been a 500 basis points rise in the interest rate since 2022.
Compared with only just 2.5%.
Yeah. Half of what was raised in the US. So now there is expectation, and that is also because till now all the Federal Reserve governors were talking about that they are done with the interest rate hikes, and now they will start looking at the possibility, and that narrative has now changed after the US inflation data came out.
Right.
And it's a very interesting thing for everyone to watch. There is something called the CME Fed Watch tool. It's it is a tool which helps in calculating the possibility or probability of interest rate cuts after the FOMC meeting. So that probability, which was very high in March, has now dwindled to single digits in March, and now it has shifted. So they are very closely and carefully looking at the interest decisions and what it will, the impact it will have on the US bond markets, equity markets, and that will have an impact on the emerging markets as well.
Of course. And okay, so now let's fly across the ocean a bit, and we come to the UK.
Right.
The latest data, which just about came out, shows that in the second half of 2023, the UK actually slipped into recession. This comes on the back of Germany, which also is in recession. So now these are still big economies, and them being in recession, how does that impact India?
So again, it's a very important source of external sector risk, because we've talked about the fact that, one of the headwinds is that exports have been in contraction zone. Our exports have been in contraction zone. And if these economies are, they are in the brink of recession, or they are already in recession, that is a bad news for our exports, because we've talked about earlier also that advanced economies, particularly the US, UK, EU, they constitute a major chunk of our exports. They are a big markets for our exports. It's not that we have been able to shift from them to emerging economies or Asian markets. There, our share is still small. So if these markets suffer, there is going to be a material impact on our exports. So it needs to be seen how the trajectory fares, because, if we look at some of the growth projections that came out, the IMF's World Economic Outlook January projection, it is expected that from now onwards there will be an improvement, because now there is again there's a possibility of interest rate cuts. Inflation has come down significantly in the UK. So in the EU now it's expected that slightly now there will be an improvement in growth rates in 2024 and 2025. In contrast, the US is expected to decline now. The US has showed resilience, now it's expected to decline. So all these factors will have a bearing on our exports.
Okay, and now we're speaking about exports, and since we're in that region, let's also talk about what's happening in the Red Sea. The attacks on the ships that have been going through the Red Sea have meant that exporters have to go all the way around the Cape of Good Hope, around Africa, which is increasing cost, increasing time, and a lot of exporters are deferring their exports. So, I mean, is that set to continue to hurt India?
Yeah, so see, the importance is that, through Red Sea, 40% of our imports are routed through Red Sea.
Imports,
yeah.
Okay.
And 25% of exports. So it's a very significant route as far as the trade is concerned. And as you mentioned, there is a rerouting through the Cape of Good Hope, which has increased the time by at least 15 days. So now that will have a bearing firstly on the freight charges. It has risen, there are lots of these indicators to show what's happening to the freight charges, and all of them show a big spike in the last 45 days. And, the freight charges have increased by, almost 150%. They have spiked in the latest 45 days. So, right now, we don't see any material impact on exports and imports. But if this continues, this sustained disturbance, because now there's military attacks by the US. So if this disturbance continues, it is going to impact exports. And more than that, it's going to impact our corporate sector, especially because there's a very interesting study last week by India Ratings. They have tried to, assess the impact of this Red Sea disruption on the corporate sector. And they are saying that firstly, those sectors which have thin margins, they don't have cash margins to tide over this disruption. They will suffer because the working capital cycle is going to increase. Working capital cycle means how much time it takes for your assets and liabilities to turn into cash. When will you get your cash back? So working capital cycle is going to increase because of the delays.
The longer route.
So there will be delays. So those who are already having a thin margin or those who do not have adequate cash buffers, those kind of industries will suffer. And then what they will have to do, they will have to borrow more. So till now, we've talked about a phase of deleveraging. The companies have been repaying their loan. We are now seeing that some of the companies have started leveraging. So trend of leveraging may increase further or may get accentuated further due to this disturbance, particularly for those sectors which have thin margins. And they have pointed out particularly sectors like iron and steel, textile. These sectors are going to be impacted.
Okay.
And also the small and medium enterprises, again, because they do not have adequate cash margins, they are going to be impacted. And they talk about different impact for exports and imports. Particularly what is going to happen is that the landing price of imports will rise, what we are importing from other countries. So that will lead to inflationary pressures because if import prices rise, there is a greater danger of imported inflation happening because of the disturbance. And exports will suffer because of the delay. There will be less export volumes and again the cascading impact. So if this sustains, it will have a bearing on our trade outlook, but more so on the corporate sector, and it needs to be seen. It will be a very interesting study to see the differentiated impact on the different sectors. Because those sectors which are, those who haven't been able to take advantage of the lower commodity prices, they are bound to suffer due to these disturbances.
Right. And this doesn't even take into account the impact on oil prices that trade disruptions are happening.
That's a separate thing because, we are now seeing oil prices again rising to above $80 per barrel. And why oil price is important is because it's a very critical input for all the models, the inflation targeting, the projections that are made by the RBI. It all is based on what is their assumption about the crude oil prices.
So that's the Red Sea issue. Now let's travel a little bit more towards the east and we come to China.
Right.
Now China is it's a huge economy and it has recovered somewhat from the lows that it saw in 2022, but there are still several issues that it has. So could you tell us a little bit more about that?
Sure. So one is that China's growth came in at 5.2% for the calendar year 2023 after the lows of 3% in 2022. But this recovery that we have seen is very patchy and still there are a lot of, cyclical and structural issues, meaning there are some short-term issues but then there are some long-term structural issues impacting the Chinese economy. One thing is their lingering property crisis, which has its origin from 2020. So real estate is a very important sector in China. It's almost contributes 1/3 of the total GDP is contributed by the real estate sector. And in 2020, the Chinese policymakers came in, introduced something which is called the 3 lines policy, where they wanted to restrict the exuberance of the real estate sector, because what was happening was that these real estate developers were taking a lot of loan and they were using that for taking money from customers also and using that for building houses. So
which were then not sold. So these were empty buildings.
So in order to restrict that, there was some restriction that only if your debt to equity ratio is up to a certain level, then you can borrow from banks. So to curb this, excess lending and borrowing by the real estate developers. These curbs were introduced, but what it turned out to be that, because they were saddled with so much of debt earlier,
Right.
they could not complete the houses because they could not access more loans, so they could not complete project. And then came a spate of defaults by a lot of Chinese real estate developers.
Yeah.
The bigger one being the Evergrande company, which defaulted on its interest payments, and then it had a cascading impact. And finally, it really shattered the business confidence and consumer confidence.
Right.
Consumers were not willing to buy houses, and there was a complete decline in housing sale,
Right.
unfinished inventories, and a lot of in 2023, a lot of steps have been taken to stimulate the real estate sector, but it hasn't worked till now.
Right.
So that is one. The second is deflation. Because prices are lower and people are not spending, there is excess supply. And so on the one side, we are talking about high inflation and inflation above the target. But then there is China, which is for the last so many months, it is in a state of deflation. That is negative inflation.
Yeah.
Other is also their debt and deficit is very high. So their debt is 280% of GDP. We are talking here about 88, 89%. It's 280% of GDP. And Moody's last month, changed the outlook from stable to negative. Citing the problems with their finances and debt. And finally, FDI, which is one of the main driver of growth, has turned negative.
Yes, it's flowing out.
Yeah, it's flowing out. So, and trade, another important driver of growth in China, has turned negative in 2023. So there are these bunch of problems which Chinese economy is facing, and this is bound to have an impact on global economy, because despite all these problems, China still continues to be the major trading partner for a lot of economies.
Absolutely.
Including India. Especially for India, we are importing a lot of raw materials. We are importing pharmaceuticals. We are importing engineering goods, electronic goods, chemicals. So there, if we are not, there is problem, it's not easy to, shift. Despite so many efforts at cutting reliance on China, that may happen, but with a lag. But right now, we do need that steady supply of industrial raw materials, and if there is a problem with China, it is not something to celebrate. So that is one. And also from our export side, also China is the fourth largest market. So we have important trade relations with China, and that is going to we need to see how that will get impacted if there is a sustained slowdown in China.
But one potential way that we can benefit, but again, only if we genuinely take steps to take advantage, is on FDI, right? If FDI is flowing out of China, then potentially it can flow to India.
Right.
So far, not a lot of that has been coming here. It's been going more to Vietnam, South Korea.
Yes.
But there are things that we can do to take advantage of that.
Yeah. So we have to improve competitiveness. India needs to become a manufacturing sector hub. We need to review our PLI schemes, whether they are working or not, in which sectors. We need to upskilling of labor and female labor force participation rate. So potentially, yes, we have opportunities, but then there is this question of short term and medium term, and therefore there are this is a headwind in the short term at least.
Right. And now we have a question from Sankalp, which actually helps us round up this conversation. We've spoken about the world, but now let's talk about India. So Sankalp asks, external risks would always be there, but I'd like to know the limits of our strength or resilience. Our huge domestic market is considered to be our foremost asset, but it's also one of limited spending capacity. What must go wrong for us to once again become one of the fragile five? Also, could we consider more GST bracket in order to efficiently shore up our revenues?
Yeah, so what could go wrong is, again, if we go back to the years when India was a part of the fragile five, what happened in 2012, 2013, where India had high debt and high deficit. So what is important is to continue to focus on macro stability. Macro stability meaning low inflation and low debt and deficit. So these are the two things that will enable us to navigate through this crisis, even though there are these important challenges that we are facing. But if we are able to continue focus on macro stability, manage our debt and deficit, and what like in the budget we have focused on fiscal consolidation.
Right.
That is something that we need to
continue that.
Yeah, continue and not lose sight of the fact that still we are very heavily indebted, even though the pattern or the structure of our debt is such that it's mostly in rupee terms. It's not dollar denominated. So we are not in a situation like Sri Lanka or Pakistan where they are dollar denominated debt, but we are indebted. So we need to bring down the stock of debt, and we need to we need to reduce our debt and deficit, and also bring down inflation to manageable levels. So that is important. And also from the GST side, I think the more general thing would be to rationalize and broaden the tax base. Whether it will be by increasing the GST slab, that is the next question. But the first thing is to rationalize the tax base and broaden the tax base, so that we are able to have a sustained tax to GDP ratio at a time when we are seeing an expenditure compression. So that is important. We have a domestic market strong, as rightly mentioned, but we need to focus on macro stability along with a manageable growth rate, 6 to 7%.
Right.
And that will help us to navigate through these challenges.
Okay, great. So there you go. We just took you on a little tour of the world of economic issues. We started with the US and we talked about how inflation there has come higher than expected, which means that rate cuts will be pushed back, and also how the treasury yields have spiked, which means that capital from India has flown, India and most of the developing world has flown to the US. Then we came to the UK, which has gone into recession according to the latest data in the second half of 2023. And we talked about how this is not great news for India, because these are trading partners of ours, and if economies like the UK and Germany are in recession, then that impacts our exports, which is not great for us. Then we came to the Red Sea and we talked about how that's increasing our export costs and our import costs, which could have inflationary pressures over here, and also increase the price of oil, which further has an inflationary impact over here. Then we went to China and talked about how its economy is still reeling from the real estate crisis. Now, a slowdown in China is not great news for India. As much as we would like to celebrate, it's a very strong trading partner of ours. We export to it a lot and we import a lot of critical things from it. So a slowdown in China is not great news. What is good news is that India remains resilient. We have seen from the budget that the government is still focused on fiscal responsibility, which is the main thing that it must do to avoid going into the fragile five of, the 2012-2013 period. But there are still a few things that we need to do. We need to bring the fiscal deficit down. We need to bring our debt levels down, and we need to keep inflation under check. But overall, we're resilient. So on that note, that's all we have. Thank you so much for watching.